People say it in every bull market. Dude, the whole market is just one stock. First it was Apple, then Tesla, then the Magnificent Seven, and right now, NVIDIA. And I get it. When one giant is huge and moving fast, the index starts to look chained to that stock's ankle. Every NVIDIA headline feels like a market headline. But here's the twist. It's usually not literally true, and it's still dangerous if you don't understand the mechanics, because once you do understand it, you get calmer. You stop panicking at every dip, and you stop assuming that if NVIDIA drops, the entire market must drop the same way. Quick disclaimer. This is educational content, not financial advice. Alright, most of the market people watch is a market cap weighted index. Sounds boring, but the idea is simple. The bigger the company, the more it counts. So when a company rises faster than everything else, it automatically becomes a bigger piece of the index. It is not because someone decided it. It is because the math forces it. And that is where the feeling comes from. A cap-weighted index is not a democracy. It is not the average company. It is a megaphone. The biggest companies get the loudest voice. Here is a simple picture to hold in your head. Imagine an index with 10 stocks. One stock is 20% of the whole thing. If that one stock rises 50% and the other 9 do nothing, the entire index still rises about 10%. That is when people say, see, one stock carried the market. In that scenario, it basically did most of the work. Now scale that up. Real indexes have hundreds of stocks, but the top can still be a massive slice. If the top names are ripping, while the rest of the market is flat, the index can look strong, even though the average stock is doing nothing. That is modern concentration. That is the real reason the meme exists. But here's the big mistake people make. They jump from one stock can move the index to, if that stock crashes, the whole market must crash the same amount. Not automatically. Sometimes leadership rotates. The leader cools off, and other sectors finally wake up. Tech slips, something else rises, and the index holds up better than you would expect. Other times, everything drops together. But when that happens, it is not because of index math. It is because of the regime. That is the key. The plumbing tells you what the index is exposed to. The regime tells you whether the rest of the market can pick up the slack or whether everything is about to move together. So how do you check this without becoming a quant? There is one simple diagnostic that is almost too good. Compare cap weight to bureau weight. Equal weight gives every stock the same weight. One stock, one vote. If the regular index is flying and equal weight is lagging, the rally is narrow. The giants are carrying the party. If both are doing well, breadth is healthier. If both are weak, the problem is broad, not just a few names. You do not have to buy equal weight. Use it like a blood pressure cuff. Quick check. Pulse reading. Done. Now, why does this feel even more intense today? Two reasons. Mega caps can get insanely large, and passive investing is huge. When money flows into index funds, those funds buy stocks in proportion to their weights. So when a leader rises and its weight increases, passive flows automatically feed it more. That can create a feedback loop where winners get even more weight, which makes the index even more sensitive to them. It sounds like magic. It is not. It is just the market's plumbing. And here's the trap. You can think you are broadly diversified while you are quietly concentrated. If you own the index, you own the top weights. If you own technology exchange-traded funds, you probably own even more. A lot of people are exposed to NVIDIA without ever consciously saying, I am buying NVIDIA. In good times, that feels like effortless genius. In bad times, it feels like you got dragged into the trade without consenting. This is also why NVIDIA becomes a macro symbol. Bullish on AI? You feel bullish on the market. Bearish on export rules, competition, capital expenditures, or rates? Suddenly, everything feels fragile. But the market can have multiple stories at once. While the biggest names cool, the rest of the market can strengthen. You only see that if you look at breadth. So how do you measure breadth without overcomplicating it? Ask 3 simple questions. How many sectors are participating? Are lots of stocks making new highs or only a handful? Are smaller companies participating or is the entire move happening at the top? Want the fastest version? Pull up a heat map. Look at the top weights. Now imagine they all have a bad week. Not a disaster, just a bad week. What happens to the index even if everything else is flat? That gives you a sense of sensitivity. Then look at equal weight and ask one question. Is the average stock doing the same thing as the index? If not, your market is more concentrated than it looks. And here's the calming conclusion. Concentration is not a prophecy that the market must crash. It is a description of where returns are coming from. In some eras, concentrated leadership can persist for years because the leaders really are compounding faster than everything else. The danger shows up when expectations get too high, or when the environment shifts and the market refuses to pay the same premium for growth. That's when you get the moment everyone hates. The company reports great news, and the stock still goes down because the market is not repricing the quarter. It is repricing the rules. Next time we are going deeper, when leaders go from tailwind to tripwire. Not by calling the top, but by watching what usually breaks first. Breadth, relative strength, volatility, revisions, and the moment the narrative starts to crack. Before you go, drop this in the comments. Is the market narrow today because the leaders really are the best businesses? Or because investors are crowding into whatever feels safest? Comment best businesses or crowding, and give me your one-sentence reason. And if you want more videos that turn market panic into simple mechanics, subscribe, because that is exactly what we are building here.